Hello, my name is Mike Sinabaldi and welcome to this week's video edition of Heard on the Street. In this edition I'm going to take a look at the following markets: the Emini S&P, Crb Index, and the US dollar. The first market that I'm going to talk about is the S&P. Most of you may be familiar with Sell in May and Go Away, which comes from Stock Traders Almanac, which in the 1980s noted that the market achieves nearly all its gains during the November to April period. The pattern has been unmistakable since 1950, but does the wave principle suggest that a long-term overdue correction is unfolding? At the weekly chart level, I've been working this bullish count and corresponding upside targets. To date, the current rally from the wave 4 low is only in 3 waves, and I have previously warned that the wave overlap could threaten the bullish count. The last weekly bar on this chart shows that wave overlap occurred as price traded below 1335.75, the wave 1 termination point. That's the first warning that the trend may be over. The second warning is the bearish 2-bar candlestick pattern called the dark cloud cover, where the market is in an uptrend, price gaps higher at the open, but by the close, price closes more than 50% into the real body of the previous bar. Given these two pieces of evidence, I'm only willing to consider bullish trades on a breakout to new highs, as resistance is the highest high of the 2-bar pattern, or 1367.25. While compelling evidence now throws caution to the count, the market hasn't confirmed that a long-term tradable top is in place either. For example, note the 2-4 trend line. If my positioning of wave 4 is correct, then price shouldn't trade below that line. As long as this trend line remains unbroken, the trend remains up. Secondly, the market has failed to put in 5 waves down. Now you might be asking yourself, why the contradiction? Well, what 5-wave pattern allows for wave overlap? An ending diagonal does. At the daily chart level, I've detailed this scenario where each successive peak is a 1.618 extension of the previous peak. While this level doesn't equate to the nearby price targets at the weekly chart level, don't forget that the 0.786 retracement of the entire decline from October of 2007 is 1390.25. A break below 1290.25 would negate the ending diagonal view. Finally, note that the RSI momentum indicator has yet to break below 40. Each counter trend has been contained as the RSI reached this critical level of support, as it did here, 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 and here. Until this area is convincingly broken, I must remain bullish and look higher. Finally, I have not eliminated the running triangle and expanded flat alternative wave counts. You can learn more about those counts at the following web address. The next market that I'll cover is the Crb Commodity Index. At the monthly chart level, I believe that the high of the year has been put in at wave 3 circle. Given the recent beating that gold, silver, and copper took, as well as most of the grains and softs, odds are that this count is highly reliable. As with the S&P, the Crb Index also contains the presence of a bearish 2-bar candlestick pattern called the bearish sash. This pattern is even more bearish than a bearish engulfing pattern. In this pattern, the bullish candle is followed by a bearish candle that opens within the bullish candle but closes below the prior candle's open. Also note, the bearish candle closes at or near its low. Furthermore, note that the monthly pivot came in right at 673. When prices get below the weekly or monthly pivot points, bad things happen. At this point, the bulls are running for the exits. Long-term target is the previous 4th wave of one lesser degree at 327.50. Near term, the first big test of this view is a test of the wave 3 at 618. On Monday, I'll be looking at option pricing to participate in this potentially lucrative play. Only a close above 679 would negate this view. The final market that I'll cover in this week's edition of Heard on the Street is the US dollar. As most readers know, I've been bearish the dollar and exited my long UUP position on January 18th of 2011 for a small loss. I've been looking for another entry, yet the wave count has been elusive other than to identify 3 wave moves. A US dollar rally is instrumental to maintain the bearish view of commodities. At the weekly chart level, one can see the exact opposite of the CRB chart. A weekly close above previous swing low of 75.23 and then 76.05 would confirm that a tradable low is in place. Looking at the Euro-US dollar pair at the 240-minute chart level, I'm anticipating a rally to 1.441 to complete wave 4, and then another round of selling to complete wave 5 of wave 1 circle at 141, or a test of the previous fourth at 141.57. I hope you found this video helpful, and best of trading.